Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Global stocks extend their rally as traders brush off Donald Trump's latest trade threats with South Korea. Gold powers higher above $5,000 an ounce. Shifting alliances, the EU and India set to announce a long-awaited trade deal in the face of President Trump's trade policies. And ahead of his trip to Beijing, the UK Prime Minister Keir Starmer tells Bloomberg he sees significant opportunities for British business in China. Plus, the Goldman Sachs CEO says he's optimistic about the outlook for global markets this year. We'll bring you our exclusive interview with David Solomon. Well, a very good morning. Welcome to Tuesday. The picture in markets looks like this. We have futures powering higher stateside and on this side of the Atlantic. And already we're seeing Asian stocks near a record. So really brushing away President Trump's tariff threats. We also have seen gold powering past that $5,000 an ounce level already. Now it's reaching for $5,100 an ounce. So the sense that the risk is out there remains. But look at oil, looking past the weather in the US and focusing instead on the forecast that supply will continue to outstrip demand. So Brent extending its drop to $65 a barrel. Turning to the risk events on the docket for today, we have that EU-India summit taking place after decades of negotiations. It looks like finally this deal that Ursula von der Leyen, the European Commission President, has said is the mother of all deals, as some have called it, could be getting over the line. So we'll bring you all of that. But then the focus turns back to earnings. Stateside, we have Boeing reporting what's expected to be profit boosted by better than expected deliveries, as we heard yesterday on this show from the Ryanair CFO. And then after markets close in Paris, we turn to LVMH. Sales expected to have taken a bit of a hit this year, but things likely to pick up in 2026 thanks to this raft of new designers. Well, we've got a lot on the agenda. Let's set you up for the day ahead. We begin with President Trump's latest tariff threats, 25% levies on goods imported from South Korea. Trump accusing Seoul of dragging its feet on implementing last year's trade deal. Let's get the Asia market reaction now with Winnie Xu. What's happening where you are, Winnie?
Yeah, morning, Lizzie. We are seeing that investors very quickly shrugging off those tariff risks. As you can see, that the benchmark Kospi here actually dipped about 1% at the open, but very quickly taking that U-turn and now rising more than 2%. Investors are still seeing this just as a negotiation tactic from President Trump, but actually a very good dip buying opportunity. As you also flip the board and take a look at how the Korean won is actually under still a bit of a pressure because investors still see Trump's agenda as more focused on that weakening trend of the dollar. Hyundai Motor here fluctuating a little bit because auto is actually one of the key sectors that was directly targeted by Trump's tariffs, along with pharma and Lombard. When it comes to what's really driving that the gains in the Kospi index, is actually SK Hynix here, up about 8%. And that's coming after a local media saying that the SK Hynix is actually the sole provider of the advanced memory HBM3E chips for Microsoft's Maya chips, and that is really driving gains here and hyping up the earnings expectation ahead on Thursday. Now flip the board and take a look at the broader Asia market because yes, overall risk on sentiment ahead of earnings, but when it comes to the Japanese yen weakening just slightly after that recent advance, and investors are still quite cautious in terms of the intervention risks. But that weakness in the yen is slightly helping the Japanese stocks here up 0.8%. Chinese stocks up modestly, and that's being helped by those industrial profits number showing the first yearly increase since 2021 thanks to the effort of anti-involution. Back to you, Lizzie.
OK, Winnie, thank you so much. That's Winnie Xu in Hong Kong. Well, let's dive into those markets now. Traders increasingly unfazed, as Winnie says, by Trump's tariff tactics, betting that he won't actually follow through on harsh penalties, often dangled as a means to win concessions. Let's bring in Bloomberg MLive strategist Mark Cranfield for more now. Mark, why don't Korean stocks seem to care about Trump's new tariff threats? Good morning.
Well, good morning. As Winnie was saying in the build-up there before, the two key companies, SK Hynix and Samsung, they are the drivers of the Korean market, have been for some time, and they are clearly two companies who are not really going to be affected, even if President Trump does go ahead with more tariffs on Korea. The sectors which he's targeting will not affect AI themes. It won't affect the chip sector. And these two major companies have been the ones which have been really buoyant and bringing in all the investor attention and driving the Kospi to record high after record high. So as long as those kind of companies are unaffected, it's not going to matter too much to the overall sense of the market. In fact, by some measures, the kinds of companies, autos and pharmaceuticals, that could be affected by potential tariffs is less than 10% of the whole market anyway. And that's not really where major investors are too concerned about. Plus, you've got, in the precious metals space, there was a bit of a wobble in silver and gold. They've recovered very smartly. There seems to be some correlation in the sentiment between what's driving precious metals and what is also driving the Korean equities as well. So as long as those two are pretty much going hand in hand, there's nothing too much for investors to get worried about as far as the Korean stocks are concerned. At some point, it will be overdone. You'll get too overheated. But for now, people are reassured that the AI theme really has a long way to go. The deal today between Hynix and Microsoft is a pretty big deal. It adds a lot more value to the company, and people are buying into that. And for now, they're able to look past anything to do with the tariff threat.
And Marcus, when you mentioned the yen's also a touch weaker against the dollar today, what's the next trigger for a potential yen intervention?
It really comes down to this auction that we have tomorrow. So just a week ago, people were really getting concerned about chaos in the long end of the Japanese market, particularly because tomorrow there's a 40-year JGB auction. That's the longest part of the yield curve. They only do this one about 6 times a year. The auctions are not on a regular basis. They're notoriously difficult to be done. The pricing is very awkward on these. Demand is very low. So there is certainly a chance that the JGB auction tomorrow will not be very successful. We'll get a spillover in Japanese bonds selling, which will go back into the yen. That's what we saw last week as well. When there was pressure on the yield curve, it translated into a weaker currency. So it could well be that the Japanese authorities are holding back slightly. They will probably know that the rate checks that were done by the Federal Reserve last week were very helpful, but in themselves, they're not going to be enough to turn the yen around. They'll need to do more. The Japanese authorities will need to step up with stronger language or direct intervention in the market. But they probably want to see what happens with the auction tomorrow. In case there's a really negative fallout, then they can step in and enter the market at a more reasonable level. If they do it today, they could be wasting their ammunition and it could all backfire. So let's see where the auction goes tomorrow. It's probably the biggest event in the Japanese market this week.
All right, we'll have to get you back to talk about it. That's Mark Cranfield, our MLive strategist. Thank you. Well, turning back to trade, just now the Indian Prime Minister Modi has said that his country and the EU have signed a, quote, significant pact today after nearly 2 decades of negotiations. The partnership aims to create closer economic ties to offset the impact of President Trump's global tariffs. Let's speak now to Bloomberg's chief Europe correspondent, Oliver Crook. Ollie, what are the terms likely to be?
Yeah, so Lizzie, I mean, this is the mother of all trade deals, of all deals, if you believe Ursula von der Leyen. That's not a quote from Donald Trump. That's sort of uncharacteristic characterizing of the deal by Ursula von der Leyen. And I think this sort of the key figure for this is 20. It's about 20% of global GDP, almost more than 20% of the global population. It's been 20 years in the meeting, and that is what this trade deal that they're hoping to get sort of over the line today, end negotiations on between the EU and India. And the key thing here is going to grant market access to a lot of different products, most of the products that are traded between the two blocs. For the Europeans, they're very keen to get some of their cars into the Indian market. India has a tariff of about almost 110% at the highest level on cars. We understand from reporting that that might come down to about 40%. There would still be a cap. There are, of course, some debates also within the European side about giving market access to Indian steel. But again, for both of the sides, this comes at a very conspicuous time, just a couple of weeks after the EU has signed that key trade deal with Mercosur in Latin America, because both the Indians and the Europeans Europeans need to diversify. The Indians are still facing a 50% tariff from Donald Trump. The Europeans are now still have their sort of trade deal with the United States on ice after that sort of debacle with Greenland just last week. And so everybody is trying to sort of strengthen their trading relationships across the world. In terms of what the actual economic impact will be for the Europeans, Allianz has crunched the numbers here, and I'll go through some of them here. It could mean an additional $20 billion worth of exported goods from the European Union to India. It could boost the European GDP, not very significantly, by only about 10 basis points, about 0.1% annually. But I think key here, Lizzie, is that it could offset nearly a quarter of U.S.-related export losses from higher U.S. tariffs from the Europeans over to India. So again, front and center here is trying to diversify away from the United States, diversify away from China for the Europeans, and striking a much more pragmatic approach with both of these trade deals coming in quick succession after being more than 20 years in the making.
OK, so that's the trade side, Ollie. But what more do we know about the proposed security and defence agreement?
Yeah, so that'll be another sort of segment of this, and well, Ursula von der Leyen is there in India to try to have these sort of discussions. And really key for the Europeans is getting obviously market access for a lot of goods, but they'd also like to get some of their defense goods into India. India, for example, and this will serve the European interests geopolitically, they buy a lot of their military equipment from Russia. Of course, that is something that the Indians are also looking to diversify away from. We had some reporting out a couple of weeks ago of them potentially looking at buying some German submarines. So that will be one of the focuses. Longer term, this could pave the way for getting, for example, joint military exercises, potentially for India to join some of the European defense programs, which gives them favorable pricing on loans and things like that. But of course, this is not all sort of natural geopolitical alignment. For the Europeans, they're very concerned by the fact that, of course, India is one of the great funders of the war in Ukraine by buying all of those fossil fuels from the Europeans. And we understand in the language for this sort of pact and this agreement on military defense pact between the Europeans and India, they could not get to a consensus on how to refer to Ukraine and to the war in Ukraine. So while it is sort of imperfect geopolitically and their interests are not 100% aligned, I think it shows that the European Union and the Indians are both taking a much more pragmatic approach in the face of the difficulties that are being provoked by the United States and Donald Trump.
Ollie, thank you so much. That's Bloomberg's chief Europe correspondent, Oliver Crook, who'll be back with us later on this hour. Well, turning to the US now, President Trump has signalled that he'll make changes to his administration's deportation crackdown. Trump's border enforcer in Minnesota, Greg Bovino, is leaving following a public outcry over the killing of 2 US citizens by federal agents. Border Chief Tom Homan is being sent to Minneapolis to ease tensions. Let's bring in Bloomberg Deputy Managing Editor Balazs Pence for more now. Balazs, what led to this dramatic pivot from President Trump?
It is indeed a dramatic pivot, as you said, Lizzie, and taken together with the fact that the president had conversations with Governor Walz and Mayor Frey of Minneapolis, and he came out of those conversations talking about how positive they were. It's clearly an attempt by the administration to de-escalate and to kind of calm the nerves around Minneapolis. But what it really tells us is just how dramatically the landscape, the political landscape around immigration has shifted. Just remember, ever since Donald Trump came on the scene, immigration has been his calling card, maybe his strongest political tool. Every time he ran into challenges, he would turn to immigration as a topic that was very favorable to him. Now that calculation has changed and it has become a liability, we've seen a groundswell of opinion against what's happened, against the sort of disturbing scenes that we've seen coming out of Minnesota over the past few weeks. And now there's a risk that there's a growing opposition even within the Republican Party, even among Republican voters, against these ICE operations. So the president is trying to take back the initiative and de-escalate a little bit when it comes to immigration in Minneapolis.
Well, yes, where does it leave his immigration strategy in the year of the midterms and the risk of a government shutdown, Balazs?
Well, that's a really interesting question because the shutdown, of course, is the strongest political tool that the Democrats have right now as the party being out of power. And as of right now, there's no indication that even this de-escalatory move by the president would change the positions of either party there. They are both dug in right now. So as of now, it seems like we're still headed for a shutdown at the end of this week.
Okay, Bloomberg Deputy Managing Editor Balash Pansby, thank you so much. Well, still to come here on Daybreak Europe, the UK Prime Minister seeks to reinvigorate trade ties with China. So we'll discuss what that means for business with the chairman of the British Chamber of Commerce in China. That's at 6:30 a.m. London time. But first, a deep freeze and hot gas prices. We'll be discussing why freezing temperatures in the US have led to wild swings in the natural gas market. That's next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, US natural gas prices have been dipping as traders take profits. Continued freezing weather conditions across much of the United States had sent natural gas up as much as 35% on Monday. There have been similar price reversals in European gas prices. And we can get more on this international market with Bloomberg's Dan Murtaugh now. So, Dan, wild swings, really, when it comes to US nat gas prices. Talk us through them.
We've seen this huge Arctic blast come down from the north in the U.S., and that's done two things to the natural gas industry. One thing it's done is you go out to like West Texas, Colorado, these places where there's lots of gas wells. It's freezing equipment at wells and pipelines and processing plants, and that's cutting off natural gas supply. And then at the same time, you're just seeing people all over the country need to add more heat. They're burning more gas to keep their house warm. They're running the electricity that's burning more gas at power plants. And so, you have a huge rise in demand pushed up against, cuts in supply. And you see these huge price increases. From January 16th to the 26th, the prices have almost doubled on the front month contract. And so, anytime you see something like that, you're going to start to have some real big market dislocations.
And just walk us through the international pricing dynamics here, because, of course, the war in Ukraine had been a massive factor for Europe.
Yeah, natural gas for ages had been a really sort of localized, decentralized markets. The U.S. natural gas market was one thing, Europe was its own thing, Asia was its own thing. But because of the rise of LNG trading, those have really kind of melded together. And as you mentioned, after Russia invaded Ukraine, Europe really relied on U.S. LNG imports to keep afloat. And so what that means now is, you have normally these LNG plants in the US, they buy their gas, they liquefy it, they ship it to Europe, they pack away a tidy little profit. But right now, these higher prices are signaling to them, hey, maybe we should instead supply our domestic buyers who are paying a little bit more, make sure that there's enough gas to go around. That, in theory, could eventually cut off supply to Europe. In reality, I think this is going to pass pretty quickly. You already look at the next month natural gas futures contract. It's significantly lower than the front month price. So this is probably a pretty quick event here. But over time, this is something that if you're in Europe, if you're in Asia, these American cold snaps are really going to be something that could affect your gas supply.
Okay. Dan, thank you so much. That's Bloomberg's Dan Murtaugh. Well, coming up, Goldman Sachs CEO David Solomon warns of a slower trajectory for talent growth in 2026. So we'll be hearing from him next. This is Bloomberg. The Goldman Sachs CEO says he sees a slower trajectory for talent growth this year, even as he made an upbeat call on global markets as a deregulatory tone boosts optimism. David Solomon spoke exclusively to us about what the market looks like this year, with a number of big-ticket IPOs like SpaceX on the way.
The environment's very constructive, for our business, particularly our banking and markets business. We highlighted in our fourth quarter earnings, our year-end earnings, that our backlog was again at another significantly high level, and it moved quite positively. I think it's going to be a very constructive year for M&A activity. Could be one of the best years, if not the best year ever for M&A activity. I think CEOs feel unleashed to really invest, drive growth in their businesses. It's a better regulatory environment. They're asking big questions about what the art of the possible is. That's very different from where we were 4 years ago, where the answer to any question was no. Now the answer to any question is yes, maybe, and so CEOs are looking forward. That's a very, very constructive environment for our business.
The stock market here regaining the IPO crown last year, and essentially on the back of all these IPOs in the tech sector. A lot of them, really, the big gainers have been the infrastructure and the not necessarily the applications or the large language models. They've been essentially the hardware players, the chips and the like. Do you see a sustainability of this pipeline from China of AI?
If the environment continues to be constructive the way it is now, yes, I think it'll be a very good year for IPOs over here too. I think there's a lot of pent-up capital markets activity because we really, coming out of the pandemic, we kind of shut down capital markets for a period of time. You got a more conducive regulatory environment. You've got a good detente in U.S.-China with a constructive setup in 2024 for more constructive dialogue. I think all that's conducive for more IPO activity here in Hong Kong. And I think you're going to see more IPO activity in the U.S. and Europe. So it's a pretty constructive setup. Now, of course, if there was a big exogenous event, it could slow it down. But I don't think that's the base case. But that doesn't mean we won't have some speed bumps along the way this year.
I think Wall Street shed about 10,600 jobs in combined, the big banks, last year. Does 2026 look like that as well? I think that was the most since 2016.
I don't have a view on Wall Street overall and its headcount. I understand our headcount plan.
Yep.
And all we've said publicly is it's probably a little bit more constrained in 26 because we see opportunities for efficiency and we're trying to deploy those. But ultimately, we've also said those efficiency opportunities give us more of an opportunity to invest in parts of our business where we can scale growth. And some of that growth scales with additional headcount. I'd point to our wealth management business, which scales with people all over the world.
The Goldman Sachs CEO David Solomon speaking exclusively to Bloomberg. Now to some other top stories we're following for you this morning. The UK Prime Minister Keir Starmer says that the public has given him a personal mandate to lead Britain for 5 years. Speaking to Bloomberg, Starmer vowed to complete a full term, signalling to his Labour rivals that he won't bow to pressure on his leadership, adding, quote, "It's a considerable mandate. I intend to deliver on that." The comments suggest that Starmer would argue only he has the legitimacy to hold the post of Prime Minister if he's challenged. Meanwhile, an industry survey has found that inflation in British shops rose to the highest level in almost 2 years as retailers grapple with higher costs. The British consortium says that prices of commonly purchased products climbed 1.5% in January from a year earlier, the fastest pace since February 2024. The British Retail Consortium says that energy costs and the hike to national insurance contributions, a payroll levy, continue to impact prices. And meanwhile, the UK government will announce a support package for pubs this week in a bid to help cushion the sector from business rates. Chancellor Rachel Reeves has been under pressure from the hospitality sector since she announced business rate reforms in last year's budget. The package is expected to be limited to pubs, with the rest of the sector, including hotels, restaurants and nightclubs, set to be excluded. And the controversial former FIFA president, Sepp Blatter, has advised football fans to stay away from America and this year's World Cup. The United States is co-hosting the tournament with Canada and Mexico this summer. Calls to consider a boycott are getting louder amid President Trump's immigration crackdown and a fraying relationship with Europe. Well, those are some of our top stories this morning. Let's check in on these markets, shall we? We have stocks already powering ahead to near a record in the Asian session and futures pointing higher both here in Europe and stateside. So traders really looking through Donald Trump's latest tariff threats when it comes to South Korea. And in the next block, we'll be diving into that theme of trade. UK Prime Minister Keir Starmer heading to Beijing, heralding significant opportunities for British business ahead of that trip. And we're going to discuss what that might entail with the British Chamber of Commerce in China Chairman Chris Torrens. So that conversation coming up next. This is Bloomberg. Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Global stocks extend their rally as traders brush off Donald Trump's latest trade threats against South Korea. Gold powers higher above $5,000 an ounce. Shifting alliances. The EU and India sign a long-awaited trade deal in the face of President Trump's trade policies. And ahead of his trip to Beijing, UK Prime Minister Keir Starmer tells Bloomberg he sees significant opportunities for British business in China. And ahead of that trip, we have had Prime Minister Keir Starmer telling Bloomberg that he sees those opportunities in China. We've also had an interview with the Goldman Sachs CEO, David Solomon, saying that he's optimistic about the outlook for global markets this year. So we'll bring you that exclusive conversation with David Solomon. Well, it is 6:31 a.m. here in London, checking in on these markets, and we've got futures pointing higher on both sides of the Atlantic. As I say, Asian stocks already nearing a record. So traders looking through President Trump's latest trade threats, tariff threats on South Korea. Gold, though, powering higher, even higher, towards $5,100 an ounce. It already smashed through that $5,000 level for the first time. But Brent here, looking through the US weather, we talked about the impact on the natural gas market. Brent seems to be more focused on the supply-demand outlook, that supply will outstrip demand in the coming months. So Brent here at $65 a barrel, extending its losses. On the front pages this morning, let's turn to the Financial Times. They have President Trump signalling a shift in his administration's immigration crackdown as he seeks to quell the outrage over the killing of a man in Minnesota by federal agents at the weekend. And the Wall Street Journal also has this story, but it tracks the 48 hours that convinced Trump to pivot afterwards as Republican lawmakers and other allies raised concerns that he was squandering public support for his signature immigration campaign. Then, if we turn over to the UK, the Telegraph is focusing on China as Britain braces for Prime Minister Keir Starmer to head to Beijing. The Telegraph reporting that China hacked the mobile phones of senior Downing Street officials close to Boris Johnson, Liz Truss and Rishi Sunak for years. But the paper says it isn't exactly clear whether the hack included the phones of the Prime Ministers themselves. But still, this paper framing UK-China relations as a balancing act between security and economic opportunity. You can get a roundup of all of these stories and everything you need to know to get your day going by looking at today's edition of Daybreak, which, as ever, Terminal subscribers can find by going to DAYB Go on the terminal. Well, let's dive back into trade. The EU's Ursula von der Leyen and Antonio Costa are in New Delhi to mark a historic free trade deal, which Prime Minister Modi has hailed as a significant agreement. Bloomberg Chief Europe correspondent Oliver Crook is back for more. Ollie, why did these negotiations take so long? And is the fact that they're seemingly now over the line likely to provoke the wrath of President Trump?
Well, yeah, let's connect those two ideas. I think the question may not be why it took so long, but why did it happen now? And why did it happen only a couple of weeks after that Mercosur trade deal between the European Union and Latin America? And the answer is that after 12 months of Donald Trump and 12 months of a sort of tariff roller coaster, a roller coaster that does not appear to be ending, whether you look at what's coming to South Korea overnight or you're looking at the sort of disagreements last week on Greenland and tariffs, basically the Europeans and India is still facing a 50% tariff from the United States. The Europeans have put their trade deal with the United States on ice after the sort of spat on Greenland last week. They need to find bigger markets. They need to find stability across the world. And that is the ambition of this trade deal that, as you say, Lizzie, has been 20 years in the making. It will include more than 20% of the world population, more than 20% of the world GDP. And the hope here is to try to get access to the Indian market by European companies, namely on things like machinery. Obviously, they'd like to sell cars there. India has had very, very high tariffs on cars and automobiles. The Indians would like to sell textiles, minerals, and other things into the European Union. This is not quite as expansive and as free a trade agreement as you see with Mercosur, but it's certainly a significant step forward and an important signal for the European Union trying to diversify away, A, from the United States, but B, also from China. There's also a security and defense pact that the Europeans are signing with the Indians, which will also serve their geopolitical interests because right now India buys a lot of its military kit from the Russians. They'd like to see some of that being bought from the Europeans, concerns. We had some reporting out a couple of weeks ago that the Indians were looking to buy, for example, German submarines. But when we think about the impact of this potential trade deal and what it could have on the European Union, we have the numbers here from Allianz giving a couple of a flavor of that. It could increase the sort of exports from the EU to India to the tune of about $20 billion. It could boost European GDP annually by about 10 basis points. But key here, Lizzie, is it could offset nearly a quarter of U.S.-related export losses from higher U.S. tariffs from the European Union to the United States. So this all part of that effort to try to diversify away from the United States in this moment here of what we can say is more European pragmatism and indeed more Indian pragmatism.
OK, really appreciate the overview. That's Chief Europe Correspondent Oliver Crook. Thank you. Well, staying with trade, Keir Starmer is seeking to reinvigorate strained business ties with China when he travels to Beijing this week, the first visit by a UK Prime Minister in 8 years. The British government recently approved a new Chinese embassy in London, ending a years-long saga that had strained bilateral relations. In an interview with Bloomberg, Starmer said that he would not be forced to choose between Washington and Beijing. We can get more now with the British Chamber of Commerce in China Chairman Chris Torrens. Chris, good morning. Thank you for making time for us. Keir Starmer, as I say, insisting that he doesn't need to choose between Trump and Xi. I wonder, do the businesses that you represent want Keir Starmer to lean more to China than the US?
I think thanks very much for having me on the show. I think any positive steps by the UK government to continue this momentum towards building a stronger relationship with China are welcomed by the British business community in China. We did a survey. We have an annual sentiment survey which was published last month. More than 300 British companies responded to that survey, all of them operating in China. And they're more optimistic than they have been for the last 6 years. So it's certainly an expression of confidence from the British business community in what the UK government's doing. And we're seeing momentum, we're seeing a coherent China strategy, which, to be honest, the previous UK administration did not have. So on the one hand, they're very confident about it, but also having senior government engagement means that some of the challenges facing British businesses operating in China, some of the market access issues that our members face, can be addressed when senior government leaders meet face to face. So I think, regardless of all the geopolitical uncertainty that's taking place, it's really positive news that Prime Minister Starmer is visiting this week.
OK, so would you just expand on that for us, Chris? What would success actually look like for Starmer on this trip?
I think there are a number of objectives that the Prime Minister would have. From a chamber point of view, we would welcome progress in areas where there are some long-standing challenges facing British businesses on the ground, typically in the more heavily regulated sectors which are regulated in other markets as well, but sometimes in China it's particularly complex. So healthcare is a strong sector for UK companies, and we're seeing progress there already. But in services, which are obviously crucial to the UK economy and where UK companies are world leaders in many areas, around legal services, financial services, wider business advisory, we're hoping for greater access as well. And I think that's something that the Prime Minister will push, not least because although it, on the one hand, it kind of pushes UK investment into China and helps companies succeed here, but UK services companies are beginning to support Chinese companies going global, including to the UK. So I think that the UK government will be looking to try to get a win in terms of Chinese investment into the UK, as well as supporting UK investment into China.
And how should the Prime Minister balance the security concerns around China, as we heard around the Chinese embassy in London, against these opportunities for economic engagement? Or are those security concerns overblown, perhaps?
So in the sentiment survey and with conversations with our members, we don't typically talk about national security back in the UK. I mean, there are various considerations in country, in Beijing, across the country, around cybersecurity, personal information, and China's legislation there is broadly in line with other countries. But I think, from a personal perspective, I think what the Prime Minister has expressed is that he's maintaining a dual focus on security and engagement. And so while pushing forward with stronger economic development and stronger trading relationships, he's also very mindful that there are high-risk sectors where China and other countries will not be invited to participate in the UK. So in your previous piece, you were talking about the balancing act that I think many countries have to make. We're in a world of increasing geopolitical uncertainty, and so I think it's important for the UK, like Europe, like the Canadian Prime Minister, Mark Carney, who was here just recently. We had the French President Emmanuel Macron last year getting lots of FaceTime with Chinese leadership. I think the German Chancellor Friedrich Merz will visit next month, and of course the US President Donald Trump himself is coming to China in April. So all of these countries will be looking to do some kind of deal. So I think it would be remiss of the UK to not engage, at least at an economic level, with China.
Well, on that triangulation, Chris, I do wonder how the trade tensions between Washington and Beijing are impacting the confidence of British companies doing business in China. Is there a sense that they can just look through President Trump's latest tariff threats because at some stage they think they'll be walked back?
Certainly last year was, I think, defined by US-China uncertainty. It was a bit of a roller coaster of a year, and it's strange to be sitting here at the beginning of 2026 feeling that the US-China relationship is probably I don't think it's putting it too strongly to say it's a beacon of stability, but there is a certain degree of predictability there. We know that the presidents of these countries will probably meet 3 or 4 times, with Trump coming to Beijing, President Xi making a return visit to Washington, and then we have the APEC forum in Shenzhen, and then the G20, which Trump will host in Miami, I think, in the middle of December. So these are 2 world leaders who will meet 4 times. One would hope that the personal rapport will grow. And so that does help to shape the mood for UK and other multinational business in China, because UK companies are members, other multinational clients of the company I work for, APCO, as well, not necessarily US companies. They've all been affected by US-China tensions. So we're hopeful that there will be a deal this year between the US and China. Whether it's going to last, given that we are now in an era of strategic competition, remains to be seen. But this year, and hopefully next year, is looking a little more stable.
Well, Chris, it's great to get the voice from business, the view from business. Chris Torrens there, Chairman of the British Chamber of Commerce in China. Thank you so much for your time. Well, speaking of that potential deal, the US ambassador to China says that Washington's making good progress in trade talks with Beijing. David Perdue also says that trade relations with NATO allies are positive, despite the recent row over Greenland. The US ambassador to China was speaking exclusively to Bloomberg. We'll hope to bring you that interview later on in the show. We've got plenty more coming up, so stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:45 a.m. here in London. Now to our top corporate news. Puma shares are seen surging on Tradegate. That's after Chinese sportswear giant Anta Sports announced that it's buying about 29% of the German sports brand, making it the biggest shareholder. Anta says the $1.8 billion purchase is a key step in the company's multi-brand and globalization strategy. Bloomberg News reported back in November that Anta was among companies exploring a potential takeover of Puma. Elsewhere, Bloomberg understands that oil majors operating in a large field in Kazakhstan have lost an international arbitration case, leaving them liable to pay as much as $4 billion in compensation to the government. The court has yet to determine the specific amount the field's partners, led by Eni and Shell, will have to pay, but sources say the external legal advice received by Kazakhstan suggests that the arbitration ruling means the partners, which include Chevron, will have to pay back an estimated $2 billion to $4 billion. And the French video game developer Ubisoft has entered discussions to cut as many as 200 jobs. The company says it's speaking to employee representatives about a voluntary termination of contracts for staff at its headquarters near Paris. Shares in the Assassin's Creed maker dropped by a record last Thursday after the company said that it would cancel game projects, shut down studios and cut its guidance. So we keep an eye on them at the Open. Well, those are some of our top corporate stories this morning. Now to the latest data. European car sales growing for a third year in a row in 2025. New vehicle registrations rose 2.4% after another bounce in December. But due to tariffs and rising competition, the European Automobile Manufacturers Association says sales are still around 15% below pre-pandemic levels. Let's get more context now with Bloomberg's transport reporter Danny Lee. Danny, what's been driving the sales so far? Good morning.
Yeah, good morning, Lizzie. So the introduction of Chinese competition, coupled with the response from the European automakers, bringing in their own affordable EVs that are sub 20,000 euros, that has been helping drive sales higher, and we have seen for the last 6 months 6 consecutive months of growth in new car sales across Europe. And so there is that momentum, and you've seen that in the EV sales, which jumped in 2025 30%, and the same for hybrids and hybrid electrics because of infrastructure not being as good. That's taken up 45% of all new car sales in Europe in 2025. So we see the lion's share going towards more cleaner electric and hybrid vehicles, and that does mean that the likes of petrol and diesel options continue to see their sharp decline in sales overall, and that really is showing that they're now in the minority.
And what are governments doing to help the industry, Danny? Will it actually help future sales?
Well, if the momentum over the last several months has shown, it could very well be a decent 2026. And the leg up we may well see from automakers is the subsidies. The likes of Germany had recently announced 3 billion euros worth of subsidies that the likes of the Chinese automakers are going to be eligible to tap into, and that could really help spur on yet more sales. And it's not just Germany, the likes of France and the UK, these major auto markets which have their own sets of subsidies and offerings to help put sales at a higher level. That would be really helpful for consumers as we see the likes of newer, cheaper electric cars, better technology, and a wider range of brands that could really heat up the competition. I think the one key thing we are kind of waiting to assess is what the European Commission had said in its announcement and agreement with Chinese EV makers recently of potentially putting in a pricing mechanism to lower the pricing or to remove the tariffs that have really dogged automakers, Chinese automakers, and their exports going into the European market, which is very much a key market for them.
Well, yeah, you're in Hong Kong. We've talked a lot about trade with China this hour, Danny. How much are Chinese brands likely to grow market share in Europe this year?
Well, the likes of BYD, the world's biggest electric vehicle maker, they racked up 1 million unit sales from the overseas markets in 2025. They've set a target this year of 1.3 million. So you could really well bet that a lion's share of that will come from the European market. And with some of the hurdles that have been in place over 2025 being removed and more subsidies in offer, you will see them really tap aggressively into that market, the likes of its rivals such as Geely as well. But overall, when you see the statistics for 2025, finally seeing a Chinese brand break into the top 10 sales of manufacturers. But that wasn't BYD, that was SAIC Motor. And you could see the likes of BYD really taking on a bigger presence in the European marketplace just as well in 2026.
OK, Danny Lee, thank you so much for the latest on those car sales and the potential for China to break in further to the European market. Well, just breaking across the terminal, we have commentary from Ursula von der Leyen, the European Commission President, of course, saying that the EU and India have concluded the mother of all deals. So she is in New Delhi alongside Antonio Costa. We already heard from Prime Minister Narendra Modi, but it looks like this FTA has got over the line after decades of negotiations. The backdrop, of course, being strained ties with Washington. That pact expected to be formally signed after legal vetting. That should take around 6 months. The European Parliament will also have to ratify it. We've got plenty more coming up right here on Daybreak Europe, so do stay with us. This is Bloomberg.
Both sides have actually already completed most of the agreements that we made in Busan. I'm very encouraged, frankly. Fentanyl, we're making progress on. Soybeans, they are on track to buy everything they said they would buy. So I believe that both sides were very genuine in their agreement in Busan. I'm encouraged by that.
That was the US Ambassador to China, David Perdue, speaking exclusively to Bloomberg's Stephen Engel. We've got plenty of other events on the docket today on that trade theme. Of course, we have the EU-India summit. We just broke the news that Ursula von der Leyen, the European Commission President, has heralded the mother of all deals, this FTA getting over the line after decades of negotiation. But it does appear that President Trump has helped that. More on that in just a moment. But we also have earnings from Boeing and LVMH. Let me take you through a couple of terminal charts to set you up for your day. So we start on trade, that theme, of course, and this marks the uncertainty that has been the backdrop of this EU-India deal. Bloomberg's uncertainty index, you can see the white line is the EU, blue is the global picture, both spiking off the back of President Trump's latest tariff threat. So that helping to get this deal done, it appears. Then if we flip over to Boeing, they're reporting stateside. It's expected that deliveries will have boosted profit, and we heard that very story from the CFO of Ryanair right here on this programme yesterday. Ryanair, of course, very loyal to Boeing. Just finally, let's flip the board over to LVMH. They'll report after markets close in Paris in the middle of Haute Couture week, of course. We have seen pressure on sales, it's expected, in this quarter, but a raft of new designers expected to boost the group as a whole in 2026. You can see here how luxury stocks have been underperforming the broader European benchmark. Can they turn it around this year? Well, coming up, I'll be speaking exclusively with the Austrian Central Bank Governor and ECB Governing Council member Martin Kocher about the rate path ahead for the ECB. That conversation at 10 a.m. UK time, but the opening trades up next. Anna Guy and Tom will take you all the way to the open. This is Bloomberg. Good morning.